So first let me say it's tough to follow our previous speaker because us economists aren't known for our inspirational message. So I just want to throw that out there. And I will bombard you with a lot of stuff between now and the end of this presentation because I am the opening act for what is a really great panel. Okay? So I'm going to throw a lot at you, but not everything. I'm not even going to cover all the ground I probably could cover, but let's get started real quick. And everybody has their disclaimer slide in government. This is my disclaimer slide. And don't worry, I'm not going to show you a whole bunch of org charts because my disclaimer slide is this. Everyone else on this USDA org chart is a political. I am not a political. I'm a career employee. So that is to say, I'm not a policymaker. I am a person that policymakers come to talk about how the markets, et cetera, work, but I am not a policymaker. So let's just jump right in. This is a slide I often show at a presentation just to kind of graphically illustrate the path we've been through on a number of agricultural commodity prices. Every one of you should be familiar with this. We talk about the fact that prices, we just heard corn drop below $4 the last time since November of 2020. This shows you that path. So way back in 20, the Chinese started coming back into the market. We saw prices start to rise, and a lot has happened over that period to where we find ourselves today. But clearly, we are on the back end of that price peak, and prices are coming down pretty sharply. And even we at USDA have significantly revised downward our commodity prices almost across the board since February, when we started putting the prices out and forecasting them. And so when I break out the prices a little bit, I'm very purposely putting those two front columns, which average kind of a price peak and a price trough. And then I'm showing you the last several years. And I'm showing you the percent change of our forecast prices for the 24-25 crop year, each of which is down double digits in terms of percent year over year in declines in commodity prices. And I'm very purposely showing you a peak and a trough in those first two columns to try and say, hey, we go through these price spikes. And I want you to remember this, and I want you to see where those prices are forecast at relative to that trough and that peak that we've observed in the past. So I'm purposely showing you these prices, but across the board, an expectation of price declines on the crop side. But it's not, as we've heard, I'm sure you've heard many times today, and as we heard even by the last speaker, it isn't just what you're getting. It isn't just the receipt side. It's what it cost you to produce it. And yes, we have seen some decline in production expenses in aggregate, but let's talk a little bit about that because we are most definitely in a cost price squeeze that is perhaps not unusual in this phase of kind of these boom and then bust. Bust is, again, there's an economist word that's not very inspiring, right? Let's call it a boom and then a tighter period of profitability. We're clearly entering into that phase. Let's talk a little bit about on the input side. Now, we have seen some input prices decline, but we're not all the way back to those where prices are back to corn's back to its November 2020 price, but not all the inputs are back to that 2020 price. So again, a cost price squeeze developing. My colleagues at ERS just put out farm income, and this is about what you normally see in terms of some input prices going up year over year, some input prices going down year over year, but they're not going down in total from where they were several years ago. Again, an issue of cost price squeeze. We continue to see, say, high labor costs. We continue to see interest rate expenses being a concern for producers. Some things, again, we see a decline in fertilizer prices, but not back to where they were 4 years ago. So, again, a cost price squeeze. And I tend to think about this through a pattern over time. So the green line is your output prices, and the red line is your input prices. Okay, so what you can see is we go through these periods where we have a shock in the market, prices jump, input prices follow them. As farmers do what they do best, which is produce their way through it, those prices fall and input prices tend to remain sticky. And so we go through these periods. Again, we saw it in the 2007-8 period. We saw it in the 2010 to 13 period, and followed by a number of years of pretty tight margins. We appear to be entering that phase of tighter margins. Could be another shock around the corner, always could be an external shock, but we are moving into a narrow margin situation, perhaps faster than I would have anticipated even in February. So we're definitely heading into a period of tighter margins. And so when you look at overall farm income, I think you are talking about, you come off of these peaks, you have several good years of farm income, and then you have several years for which oftentimes producers have to live on that, off of those few good years. And at the moment, that appears where we're at. Again, I'm not forecasting 5 years of lean times. I'm just telling you we're moving into, at a global supply level, we're moving into a period where it looks like margins, there's not an obvious point on the horizon where we'll bring those margins back to where they've been the last several years. And I think when you break out this farm income, though, I want to dig in just a little bit more and talk about it. You really have to dig into the details to look at the year-over-year change in farm income as well, too, and distinguish a bit between what you are seeing on the crop side and what you are seeing on the livestock side. When you look at the crop side, I think things are much more challenging than the overall number would show. Right? We've got lower commodity prices, sharply lower commodity prices. So for those row crop producers, it's a challenging environment, farm income falling more than something very distinct, which is over on the livestock side, where we actually some year-over-year increase in farm income, and a lot of it driven by prices. But when you dig in a little bit more on the livestock side, there are some issues there. Eggs are doing a lot of that driving. Why? Because we have HPAI cutting supplies in a pretty inelastic market. If we had more beef and beef producers had confidence and didn't have as much concern about interest rates, we might have more beef to sell. We could sell the beef if we had it, but there's a challenging environment. So you see a very distinct change, a very distinct difference here between the fortunes of the row crop producers in this number and the fortune of the livestock producers, crops and livestock. And so when you look at this in more detail, again, you can start to distinguish between these two things in terms of prices. Prices on the crop side really having the effect of lowering farm income. Okay? So again, my colleagues at ERS looking here about what's driving the fall in farm income, and again, looking at net farm income changes and how their forecasts have changed, things getting a little bit more problematic on the crop side, things improving on the livestock side. On the livestock side, it's mostly price, and those aren't necessarily things which are a long-term benefit to the livestock producers either, because they'd like to sell more if they had it. Let's turn a little bit to crops, and I'm going to blow through some crop, overall global crop information and talk about a few row crops as well too. I look at this, and part of the reason that we're seeing softening commodity prices is because we have seen some improvement in some of the commodities in terms of global carryout. I know we have some Kansans in the room as well too. Why wheat prices remain so cheap, I'm not sure. Considering things that are on the global market, we can have that discussion. But clearly, you see that we have had a period of a little bit greater global carryout outside of China. We just produced our latest corn yield at USDA last week. Record corn yield, above 180 bushel an acre, a good-looking crop at a period when commodity prices, already putting some downward pressure on commodity prices, already entering the expansion of supply on the domestic market, giving us the second biggest U.S. corn crop on record. What are we going to do with that crop? Well, we got to have a combination of a robust livestock market domestically, got to send some to the ethanol plant, and we'd like to be able to export it. One of the challenges on the export market is where are we going to send it and how export competitive are we? When you look at this, this is what China takes in that is corn or light corn, and I may have shown this here in years past. One of the distinct differences, perhaps what I showed you in the past, is there is the blue Brazilian corn. That is a demand that China did not have in the past. China has now begun to accept Brazilian corn in the last year, year and a half, and that has really changed the competitive position for U.S. agriculture by way of exporting corn to China. Now, fortunately, the Mexicans have decided that cheap corn is a good thing, and we've seen a little bit more corn moving to Mexico, but that's not without concern either. The Mexicans have made some statements about GMO corn, and they've obviously proven to be a very good market for us. Let's talk real quick about the soybean side. Here, another record soybean crop. Soybean production coming in quite strong, producing a record soybean crop. Large amounts at the global level too. Expansion of global carryout in soybeans. So we have a lot that we need to do with it. One of the spots we might have talked about last year is crush for biofuel production. We might have talked about crush for biofuel production. But what we have observed is, indeed, there is a demand pull for feedstocks into the biofuel market. That's what's on the left. And I grayed out those two bars because that's year to date, right? Because I don't have a full 2024. You can just compare it to the pace we're on 2023. But you can see the feedstocks that are being drawn in. There are feedstocks being drawn into the biodiesel sector, the renewable fuel sector. But what are some of the big drivers there? If you look at the right, you can see large amounts of imports, both canola oil from Canada, which was already coming in to some extent before, and obviously large amounts of growth of used cooking oil from overseas, for which we can have a robust discussion during Q&A. All right? So clearly we're bringing in a lot of product. We've also seen the interaction with California policy where they are proposing to cap canola and soybean oil use in biodiesel production. They represent a big chunk of biofuel use, and so therefore California policy is pretty important when it comes to overall biofuel use, and the proposal would only incentivize further UCO importation. So this is a real question, both from a what is UCO and what kind of policy is being incentivized here, and what does that UCO actually look like from a carbon intensity score perspective. Let's talk a little bit about trade. We've seen historically that we have normally run a trade surplus in agriculture. We are looking at a record trade deficit in agriculture, and for a couple of reasons. The things which we depend a lot on for exports, bulk commodities, have seen their prices soften significantly. And at the same time, a strong dollar incentivizes imports of a lot of high-value goods. Spirits, for instance, fall under the horticultural part of this import, and we've seen pretty strong imports, right? So we're importing a variety of high-value products to some extent. To some extent, things counter-seasonally to our own production, and exports are facing a real challenge, and that's part of what's leading to this trade deficit. Here's another way to look at this as well, too. I really love this graph by my FAS and ERS colleagues because you can start to distinguish here in terms of everything red means lower trade value from the prior year. And you can dissect it in terms of volume and value. And so what you can see here is prices are coming down. We're getting a little bit more volume. Price is doing a little bit of the work. Price is moving some of these products a bit more into the global market, but not enough to offset those price declines. So again, the bulk commodities that we tend to export facing some challenges in terms of competitive pricing in the global market, and that's leading to some of what we're seeing about the record trade deficit. The other aspect of this is the Chinese are diversifying also where they're buying their commodities from. They've gone from, back when we were facing trade friction with China, they fell as low as 5th. They are back down to 3rd after spending several years at number 1. And they too are diversifying from who they're buying from. We just talked a little bit about the fact that they're buying corn from Brazil, which they hadn't in the past. Their economy is facing some headwinds as well too. They're diversifying where they're purchasing from. We are facing some competitive challenges in the export market. And yet we're having good trade with Canada and Mexico. Most recently, some of the movement and exports we've seen has been corn to Mexico, where the Mexicans have come in and bought, and that's a good thing. Let's talk quickly about livestock as well, too. Again, I was talking to you about farm income. The positive for farm income has been the livestock side, but again, had we more of these products of livestock and dairy to sell, we could sell them. So we have some supply constraints in the face of good demand. You look out here and you talk about very strong cattle prices, but we're in a contraction phase of the cattle market, and when I talk to producers, the choice is between risking it and an inflation cost in retaining those heifers and expanding the herd and seeing quite high feeder prices today and taking the money and cashing out. Okay? I keep looking for the turn in the cattle cycle. I keep looking for it. It hasn't come. The producers so far are saying, I'll take the money now. I'm not yet ready to face those interest rate charges and the risk in going forward. And so we continue to shrink the size of the cattle herd. For things like eggs, we continue to see impacts. Again, this is a highly inelastic market in the short run. What does that mean? It means we can see a 5% shortfall in the number of layers we would like to have to balance the market, and yet see a much more than a 5% increase in the egg price. Only 5% fewer birds leads to a huge increase in prices. So yeah, if you happen to have eggs to sell now and you're not under a contract to provide those eggs, you could make money in the short run. But if you had more eggs to sell, you would like to. So again, supply constraints on the livestock side, all right? And just as an aside here as well too, we always predict no HPAI in our forecast for egg prices. So this is an egg price forecast assuming we will have no HPAI in the fall. And I think if we look back on the last few falls, that's been a real challenge in order to say that that's the probable outcome, but we don't predict HPAI. Now, there's a lot of folks on the policy side for which these types of things are a real question. Here are the things that have been contributing to food price inflation over the last year. And so you talk about food price inflation year over year, eggs has presented an outsized push on food price inflation. So it clearly gets a lot of attention. And then you see other things like full service and limited service meals and snacks. So you distinguish between food at home and food away from home. And again, a contributor to food price inflation, which includes both at home and away from home expenditures, has eggs surely on one side, but it is also the service component of buying food at restaurants. Okay? So when you look at this, here's your food price inflation, and here I'm distinguishing between food away from home and food at home, and that line is not zero. That line is a more normal pace of food price inflation. And my colleagues at ERS produced this excellent publication as well too. And looking at this each month, and what you see is just because food price inflation has fallen and food at home is now below the long-term trend doesn't mean food is getting cheaper. There's two ways to read this. It's just not increasing at the long-term rate of food price inflation. Doesn't mean it's getting cheaper when it's below that line. It just means it's not getting as expensive as fast as it normally does. Nor has it retrenched over what we've observed in the last couple years, but we're now coming back into line where things are normalizing in terms of overall inflation, but there is still some inflationary pressure from food away from home. I'm covering a lot of ground here, folks. I think you heard a little bit about Prop 12 as well, too, in terms of policy, and I think that this is one of the places where we also keep an eye on these other things which are affecting domestic markets. Food price inflation. Here's a graph that talks about the price of bacon, one of my favorite products, outside of California and inside of California, okay? And so one of the things that you notice quite here is you got that vertical line there, that's the imposition of Prop 12. Bacon inside California and bacon outside of California. You see a clear split in the price of this product, okay? And you can see that in lots of products. So here's pork loin. Here's ground pork. I'm going to explain that one. And then bacon you just saw. Ground pork isn't covered under Prop 12. And so while you see a bunch of noise in there, the price difference between California and the rest of the country doesn't change. Because you can't. Because it doesn't have to be compliant. You can send ground pork from anywhere. And so these state-level policies, kind of like California's cap on soybean oil and canola oil, have impacts into the market, and for California, in this case, for California consumers, most definitely. And the costs, when you think about this, you say, okay, the sow needs more room. That's not where the costs end. The costs don't end on the sow, right? You need to give the sow more space, there's cost. Therefore, to make up that cost, a producer who's producing Prop 12 compliant pork has to receive a higher price. Makes sense? You see that price increase. But that's not where it ends. You have to segment that product and you have to prove that compliance all the way through to retail. And so, at least our initial research says the cost to California consumers continues to add beyond the sow. It goes to the next level of making sure you have segmentation, and then it goes on to the next level in order to retail it to those California consumers. And thus far, you saw that spread in those prices. It is the California consumers that end up paying for this. So this is a bit different. It's one of these things that we often wonder about in terms of, does state policy stay within the state, or does state policy extend into other areas? At least for Prop 12, the people that wanted the policy are the ones that are also experiencing the changes due to the policy. That's what we've observed so far. But from an overall perspective, in terms of the ag sector, this is consumption of pork within California. This is California's share of overall U.S. consumption of pork. And you can see the implementation where it drops off, shortage of Prop 12 compliant pork perhaps. And then you can see that California consumption of pork has fallen off pretty substantially. So when we think about policy impacts within a state, they absolutely have impacts on the ag sector outside of California. But California consumers are also the ones that are ending up paying for this. Okay? So just a couple more quick slides, and then I hope I set the panel up. Mississippi River level. We continue to see supply chain shocks. First it was Panama Canal and Suez Canal, and potential issues of disruption of containerized shipments throughout the Port of Los Angeles, which carries 50% of U.S. agricultural containerized exports flow out of the Port of Los Angeles. We've seen containerized costs rise, and that has been in the past a problem for us in terms of overall ag exports, containerized ag exports. So a challenge here, and again, seeing some challenges for our export competitiveness through low Mississippi River levels. U.S. Drought Monitor. We see, and I always hate to show this one in the fall when it perhaps doesn't matter and things could change easily by spring. You winter wheat producers will say, well, it does matter. No, absolutely. But we've seen drought creep back into a lot of areas that we hadn't seen it 6 months ago. Okay? So this is also my way to say, yes, we are entering our period of tight margins, but I am not going to call the fact that we won't have a shock, given the number of shocks, whether it's the Ukraine war, whether it's COVID, whether it's shipping through the Suez Canal. I don't know what the next shock will be, nor do I know what other countries' responses will be to those shocks, but certainly we've got some uncertainties when it comes to drought and prices for margins in the coming year. And then there's a whole bunch of things I didn't talk about. I didn't talk about the Farm Bill, which we've got experts coming up that can talk about that in great detail, and I'm happy to join in. We didn't talk about 40B and 45Z tax credits. We didn't talk about the intersection of crop insurance and conservation practices, as I'm the head of the Federal Crop Insurance Corporation Board of Directors. So there's a lot going on, and this is just a narrow slice from the economist's perspective. So with that, I'm happy to wrap up and have the panel.